Okay, so hello everyone. Very good morning to all of you. How are all of you doing today? So quickly, can I see some hands up? How many of you are there on the call already? Can I get some good mornings? Can I get some hellos on the comments? Good morning. How are all of you doing? Okay, so I see some people already joining in. That's good. Hello, Ignatius. Good morning. Hi, Alok. How are all of you doing today? So, guys, we're just going to wait for maybe 2 to 3 minutes for some more people to join in, and then we're going to start the session. Thank you so much for all of you who've already joined in. Hi, Mohit. I'm good. How are you? Uh, Maruti Manohar. Hello. Good morning. Yes. Hello. So, yes, so we're just going to wait. How are all of you doing today? How is your weekend going? I hope all of you are doing well. So yes, so I see quite a few have already joined. Hi Sakib. Hello, Mr. Monster. Hi. Okay. Anyone else who's okay, so just a quick question. Am I visible to all of you? Am I audible? If someone could just give me a heads up. Hi Gagan, I'm fine. Thank you so much. How are you? Thank you, Ignatius. Good to know. So Ignatius, if you could just tell me if I'm visible, audible, everything is fine. Hello, Srinivas. Hi, Anurag. Namaste. Yes, full visible. Thank you so much. Thank you. Thank you, Ignatius. Thank you. Yes. Okay. Okay. Well, thank you, Gagan, Safrina, Sakib. So good to have all of you here. So, okay, just a quick question to all of you. How many of you, this is the first masterclass? Just give me a yes on the comments and tell me for how many of you this is the first masterclass that you're attending? Hi, Prasanna, Ashish, Pulkit, good morning. Pratmesh, Shiv Kumar, Shubham. Don't worry so much, Shubham. It's going to be fine. Don't worry. Yes. So, for how many of you this is the first masterclass? Okay. So, Pratmesh, Shiv Kumar, Anurag, Sakib, all of you. Okay. Yes. Okay. Srinivas, first class. Okay. Very good. I have a lot of new people who are joining my session today. Okay. Third one you're attending, Ignatius. Thank you so much for attending my masterclass. I do hope you're getting to learn something from each of these masterclasses that I'm doing for all of you. Okay, hi, good morning, Soumya Deep, Animala, Mr. Monster. I want to invest in, I don't know. Okay, great. So you're going to learn a lot, don't worry. Okay, thank you, Lalit, for joining in. Hi, Dhanjeet. Okay, very nice. Yes, Kisan Patel, hello. Hi. Yes. Yeah, so any specific expectation from this particular session, guys? Is there anything specific that you want to learn? You can just tell me. Thank you so much, Mr. Narsim, and good to have you back. You always attend my sessions. So good to see you again today. Hi, good morning, Vijay. Yes, okay. Hello. Hi, Suman. Good morning. Guys, just one more minute and we're going to start, okay? Yes, thank you so much for joining in, all of you. Okay, so I think let's start and let me quickly introduce myself. My name is Namrata and I've been working with Groww for a while. We do a lot of I do a lot of videos for them, a lot of content, masterclass. This is a series that we've been running for the last 6 months, and it's been quite successful. I have a lot of people who want to listen to me in the masterclass, and that's the reason we are doing this. So thank you so much, everyone, for joining in, and for all of you for whom this is the first masterclass. Thank you so much for coming and listening to me. And for those of you who've been attending my masterclasses in the past, thank you for coming back again and again to listen to me. So thank you so much, guys. So today we have a very interesting topic, but just a few disclaimers before I start the session. Okay. The first disclaimer: this particular session is going to be in English, and I'm going to do the same thing in Hindi at 12:30 today. Okay. So for those of you who want to listen to me in Hindi, you can join in at 12:30, and this one is going to be in English. So I would expect no language related problems here. So just I hope we're good on that front. Next, when it comes to any form of recommendation, so if you're going to ask me, is this stock good, is this mutual fund good, I will not be able to answer those questions, right? So please don't ask me those questions because we don't give recommendations. Now, one thing that I want to tell you, that today's topic is a super interesting topic. Today we're going to talk about financial ratios. Yes, But while I'm explaining financial ratios, I'm going to take some examples. So I'm going to take some examples of companies where we're going to talk about their financial ratios. So please do not consider that as a recommendation that I'm giving. It is just an example to explain a particular concept. Okay. So I'm giving that as a disclaimer in the beginning itself, that I'm not giving any recommendations in the session today. And all the examples that I'm taking are just for all of you to understand how those ratios work. Okay. So please don't take them as an advice from my side or from Grow's side. That's just going to be purely for academic purpose. Yes. Okay. So let's start. And today we're going to talk about financial ratios. I'm going to quickly share my screen with all of you first. So you will just have to give me 1 minute. Okay. Yes. So I'm guessing my presentation is visible to all of you. Yes. Okay. Great. So, yes, and you can keep the questions going on the chat, and I'm going to spend the last 5 to 10 minutes taking all your questions. So, all your questions, I will try to answer to the best of my capacity after the talk is done. Okay. So, today we are going to talk about financial ratios. We're going to discuss about, how to analyze financial ratios, what are these financial ratios, and so on, right? So I do believe that there's this general understanding that equities are risky, and I'm sure all of you agree to it, that equities are risky, and there's no denying that. Stock prices are definitely volatile in the short term. So if you're looking at a short-term view of equities or of investing in stocks, it is going to be volatile. So that's a short-term risk which is there when we are investing in equities in the short term. Now, when we are looking at, say, long-term risk associated with equity, so if you're investing in a particular company, right, what's the long-term risk which is associated with it? Of course, there are certain risks, right? Think about the fact that you've invested in a company, but it is not generating enough profit, right? So obviously the share price is not going to move up. Or maybe the company is struggling with a lot of debt, or worst case scenario, maybe the company is shutting down, right? These are some of the risks which are associated with equity, because when you're investing in companies, these risks come, these investments come with these risks. So when we say about short-term volatility, you can avoid short-term volatility in a particular stock by investing for long-term. You can at least to some extent reduce that risk by investing for long-term. But then how do you get rid of the long-term risk that we are talking about, right? That long-term risk, which is what if the company has a lot of debt? What if it gets into trouble? What if it's going to shut down? We have those challenges. How do we get rid of that? How do we reduce it, right? So for that, it is very important that we understand about a company, right? So whenever we are investing in a particular business, it only makes logical sense that first we understand about the business, we analyze the company, and then we invest in it, right? And when you are investing in a particular company, you can look at two aspects. So you can look at the quantitative aspects and you can look at the qualitative aspects, right? So when we say qualitative aspects, it's things like the business model, the future growth potential, or the management and so on. But the quantitative aspects are basically the numbers. Yes. So in today's session, we're going to discuss the numbers that you can analyze when you want to invest in a particular business or in a particular company. Yes, we call them quantitative aspects or quantitative factors. Yes. Okay. So now, when we are, looking at investing in a particular company, and if you want to analyze their numbers, the best thing to do is you look at the financial statements. Yes. So we have three types of financial statements. You have your income statement, income and expense statement, which is nothing but your P&L account, the profit and loss account. Then you have your balance sheet and you have your cash flow statement. Yes. So these are the three statements or financial statements which are available in the public domain for investors to analyze. And when we are looking at all these statements, I do believe that a lot of people would say that if I'm investing in a particular company's future, then why should I look at the past? Yes. So now the question is, there's a very beautiful saying which basically says that history repeats itself for those who are unwilling to learn from the past. So this basically means that there are a lot of lessons that we can learn from the past, and that is what we should be looking at. So yes, going through financial statements is an important step in stock selection. There's no denying that, especially if you are looking at holding a particular stock for the long term. But trust me, when it comes to looking at the financial statements, Do you think reading a financial statement is easy? Reading a financial statement is by far one of the toughest things which is available. If it is not an easy exercise for simple investors like you and me. So, which is why if reading a financial statement is difficult, then what do we do? Then what we can do is look at financial ratios. So basically, the whole summary of all the financial statements in a nice, summarized, comparable form is the financial ratio. So if you think that you find the financial statements very complicated, then just look at the financial ratios, which are basically the summarized version of the financial statements. Okay. So, financial ratios are basically those very important numbers which help in understanding the company's financial health and the historical trend. Yeah. So, if you were to, see the track record of the company's performance over different cycles, economic cycles, right? So, you look at when you open the financial statements, for example, and you look at the historical trend of the company, you will see that there are different economic cycles, right? And based on those economic cycles, the company would have done well or maybe not done well. So then it will give you how good the company is in terms of managing these different economic cycles. So how the company is able to manage those challenges is what that is going to help us in this particular aspect. So let's look at what are some of those financial ratios that we're going to look at. There are different financial ratios, and don't get confused with this slide. Don't look at this in the sense that when it comes to financial ratios, we have liquidity ratios, financial leverage ratios, profitability ratios, and the valuation ratios. Am I going to tell you all of them? There are a lot of ratios on the screen. I'm not going to explain all of this. I'm not going to make it a proper accounting class for all of you. I'm just going to pick some of those important ratios that you should look at while you are investing in a particular business. Okay. So, for example, now what are profitability ratios? So profit is by far the most important essence of any business, right? I mean, without profit, why should you be running a business, isn't it? So these ratios, the profitability ratios, they basically help us in understanding the operating and the net profit of the company. Okay, that's the profitability ratios. Then we have liquidity ratios. So what exactly are liquidity ratios? So they help in understanding the company's ability to meet its short-term obligations. So basically, every company has short-term obligations. Right? You have to pay the vendors, you have to pay the suppliers, you have these short-term obligations. So how well the company is in terms of meeting those short-term expenses. Yeah. So basically, think of it like a working capital management. And these ratios, liquidity ratios, help us in understanding those aspects, the liquidity aspects. Yes. And trust me, any issue in terms of the liquidity ratios could have a lasting impact on the company. Okay. Next, you have the leverage ratio. So, leverage ratio is nothing but the company's debt position. Okay. So, basically, how well the company is equipped to service the debt that it has. Yes. So, the companies have loans and so on, right? How well it is servicing those loans is what the leverage ratios would tell us. And then you have the valuation ratios, which are very interesting. They help us in understanding if the company is fairly priced or not. Okay, so basically, it helps us in understanding the value of the stock price, right, of the company. So if a particular company has, a particular stock price, is it fairly valued? Is it overvalued, or is it undervalued? Is what the valuation ratios tell us. So I'm going to talk in each of these four categories. I'm going to pick up a few ratios and explain the concept to you. And I'll pick up only those ratios which I do believe are important, which are going to help you in understanding the company. Okay. So let's start with the very first important ratios, which is nothing but the profitability ratios. Okay. So now when we are looking at profitability ratios, like I said, these ratios, they basically throw light into the profit which is generated by the company relative to the revenue, capital, assets, and equity. Yes. So profits is what we are going to be discussing in the profitability ratio. So first, let's understand what is gross and net margin. Yes. So for every company, there's something called as gross profit margin and there's net profit margin. Okay. So what is gross profit margin? So gross profit margin is nothing but profit from the core activities of the business. Okay. So for example, if you're looking at a phone and say a particular phone is sold in the market for say 20,000 rupees, and when you look at the statement, when you look at the income statement, it says that the cost of manufacturing the phone was say 8,000 rupees. Okay. So When we say cost of manufacturing, that probably includes the cost of raw materials, cost of manufacturing, labor, all of that is the manufacturing cost, and that is 8,000. So now this is the direct cost of manufacturing a particular phone. So therefore, the gross profit in this particular example would be 12,000 rupees. If 20,000 you sold the phone, 8,000 is the direct expenses related to the phone, direct expenses. Then your profit, gross profit is 12,000 rupees. So if you look at the gross profit margin, that is 60%. Okay. Now, what is net profit? Now, net profit is when you deduct all the indirect expenses as well, right? So you look at, say, interest, depreciation, taxes, and all of that. When you reduce all of that, and basically, net profit is the profit that belongs to the shareholders. Okay. So we also call net profit as PAT, profit after tax. You would have heard of it, right? So PAT, profit after tax, is nothing but your net profit margin. So going by the same example that we were just discussing, the manufacturing cost of the phone is 8,000, but say the other costs, like say there's advertising cost, there's marketing expense, there's admin, there's interest, there's tax, all of that put together amounts to another 8,000 rupees. Okay. So then now what's the total cost of the phone? That is 16,000. Okay. And what is the net profit in this case? It is 4,000 rupees, or net profit margin is 20%. Okay. So which is what we are trying to say, that in statements, when we hear things like the net profit margin is say 20% by a company, it sounds okay. It sounds all right. Yeah. But what we also need to understand is that net profit margin consists of net profit and revenue. Okay. I want all of you to hear me out very clearly when I'm talking about this particular aspect. The net profit consists of net profit and the revenue. And what happens is revenue includes both sales. So whatever the sales have happened for a particular company, revenues, sales is a part of the revenue, and income from other sources like investments or rental, sale of a particular asset, and so on. So if a particular company has sold a particular asset in a year, that also becomes a part of the revenue. Now, if you look at sale of an asset, generally is not a regular activity. Okay. You are not going to sell assets on a regular basis. Not like it is something that you know is going to happen. Correct. So it's not a regular activity. So in a year, when the asset is sold, so if say for a particular company, if an asset is sold, the overall revenue would shoot up for that particular year for that company. Okay. And which will show higher profitability for that year. So this is an extraordinary item, and ideally when you are analyzing, you should remove these extraordinary items and then look at the figure. Okay, so let me give you an example. So during this week, Reliance Industries, they declared their quarterly results, and the company showed beautiful performance, stellar performance in terms of revenue, in terms of profit growth. The net profit of the company is rupees 20,500 crores. That's the PAT. Okay. But out of this 20,500 crores, 2,800 crores is from the sale of shale gas. Okay, so 2,800 crores just comes from the sale of shale gas, which is an exceptional item, right? So ideally, when you're calculating the margin, then you look at removing the asset value of this. So you look at removing the 2,800 crores, and then you calculate the net margins. Okay, so when you're looking at numbers, right, they can they can be a little different. So you have to really look at all these aspects. Sale of an asset is an exceptional item which should be removed while you are analyzing the net profit margin of a company. Okay. Now, the other angle to understand is that there is no generic cutoff like 15% net margin is good or whatever, because it will vary from industry to industry. Now, what I'm showing you on the screen right now is a very interesting chart. Okay. So what is this? It says that this is the data as of 5th of Jan. So it's like a super latest data. Okay. If you just look at this tells you the industry-wise margins. Okay. Industry-wise gross margins and the net margins. And it also tells you the number of companies in that particular industry. So how many companies are there? Ideally, competition should be less. So what's an ideal scenario? Ideal scenario is number of players in that particular industry are less, which means competition is less, and your gross margins and net margins are on the higher side, logically, correct? So for example, now let's look at BFSI space, and let me just expand this for all of you so that it's a little more visible. Yes, okay. So if you just look at BFSI as an example, Companies generally have higher margins. Okay, if you look at, say, the banks, just look at this particular aspect, right? So if you just look at the banks, there are 31 banks, and look at their net margins and their gross margins, it's pretty high. But similarly, if you look at the regional banks, okay, in the regional banks, the net margins have been very low, especially during COVID times. When I say regional banks, there are five regional banks. They are AU Small Finance Bank, Bandhan Bank, CSB Bank, Dhanalakshmi, and Ujjivan Small Finance Bank. So these are the five banks that belong to the regional banks category, and they have negative net margins. Okay, so, which what I'm trying to say is BFSI as an industry would have done well because the net margins are quite high. If you just look at banks, it's 19.45%, but regional banks have not done that well. Okay. At the same time, when you look at, say, brokerage and investment banking, right? So when you look at this, 169 firms, now that's the kind of competition that you're looking at, and the net margin drops to about 8.15%. So net margin is also on the lower side for brokerage and investment banking firms. Now, similarly, if you look at, say, sectors like pharma and software, they present pretty healthy profitability ratios, especially during COVID times. So when you start looking at companies individually, it makes sense to compare the performance of the company to the industry average and see where the company that you're doing evaluating stands. Okay, so now what I'm going to do is I'm going to show you an example of Infosys and TCS. Okay. Now, Infi and TCS. So today, when I'm explaining these ratios, to a large extent, I will try using. I'll try using these two companies' example to explain the ratios. Okay. So if you look at, say, Infosys and TCS, they're categorized in the computer services segment, and the net margin for this segment is about 15.52%. Okay. But if you look at both Infosys and TCS, they're both beating the industry net margin. So, for example, if you look at Infosys, that's 21, and this year wise, right? In 2021, it was 19.3. And TCS is slightly better than Infosys, but not much of a difference. But both of these companies are beating the industry net margin, which is 15.52%, because they've got, say, 19.8, 20.7, 21.5. So they're literally beating the industry average in that sense. Okay, so this is what you look at, but then what you also have to look at is you've compared these companies with the industry. Now if you look at the historical trend as well, so this is the historical trend of Infosys. Okay, and if you look at the net margin trend from, say, 2013-14 till 2020, you see a downward trend in terms of the net profit margin. So if you just look at this as a standalone chart, you're going to say that, maybe, I don't know if it's a good company because the chart is downward or the trend is coming negative year on year. But if you still compare it to the industry margins, it is still on the higher side. It's still doing better than the industry or all the other companies within the industry. Okay, so which is why when you're looking at the profitability ratios, what you look at is you compare it with the industry margins, and you can also look at the trend, the historical trend of the company, to see if it is something that that works for you as a company. Okay, next, what we're going to talk about is these important ratios: return on assets and return on equity. So, or return on capital employed. Okay, so now if you look at, say, ROE and ROA, they are, of course, very important ratios that we should be looking at. Return on equity, or ROE, basically talks about the returns which are earned by the equity shareholder. So if you are an equity shareholder of a particular company, what's the return that you have earned, right? Return on equity. So that basically is, how do you calculate that? You don't need to know the formula, but just a simple thing is, it's basically the profit after tax of the company divided by the shareholder's equity. So the PAT divided by shareholder equity is going to help you in terms of getting the ROE number. But of course, if these numbers are available on a lot of websites, including the Groww website. If you just go to the Groww website and the Groww app, you'll be able to see all the numbers like ROE, ROA, and all the other financial ratios on their app for every company. Yeah. Okay, so now higher the ROE generated by the company or generated by the stock, and that's obviously going to have a favorable influence on the stock price, obviously, right? When we are looking at ROE, we are looking at companies which are giving high ROE. We are looking at companies which are giving high return on equity. So the understanding is that companies with higher ROE are capable of generating cash internally. So logic is they're capable of generating cash internally, so they're going to have less dependency on debt financing. Okay, so which is why a higher ROE number is always considered to be a good thing. Now, what is ROA, or return on assets? It basically reveals the percentage of net earnings compared to companies' total assets. Okay, so basically, companies with lower ratio are considered to be asset intensive companies. Yeah. So for example, if you look at tech companies or IT companies, they're generally lower in less intensive in terms of assets. But if you look at manufacturing, automobile, all these companies are obviously higher in terms of, or more intensive in terms of assets, right? Obviously. So asset intensive companies, they require higher investment for obviously to buy those assets, for purchase of fixed assets like machines, equipments, and so on. And software firms, IT companies, they're less asset intensive companies. So if I just show you again Infi and TCS chart, yes, so can you see that? So in terms of their net profit margins, there was not too much of a difference, but both of them were beating the industry average. If you look at their ROE and ROA, TCS outright beats Infosys, correct? So in terms of return on assets, also TCS is higher. In terms of return on equity, also TCS is higher compared to Infosys. Yes. So when you're comparing these two companies in the same industry, yes, TCS does better compared to Infosys in these aspects. In terms of net profit margin, they're almost the same. So if you just look at the ROE of computer services industry, that is about 28.71. Okay, so which means Infosys is not beating the industry average in terms of ROE, whereas TCS definitely is. Okay. But again, what you also have to understand is that it is going to be reflected on their stock price as well. Then, of course, you have to look at other ratios also. These are not the only ratios that you look at while you're selecting a particular company, but of course, these are the important ratios that you look at. Now, if you look at, say, ROE and ROA of some capital intensive companies, say maybe a Maruti Suzuki, just a minute, do I have? Okay. So if you look at, say, examples like, say, Maruti Suzuki, which has an ROA of 6.03% and a ROE of 8.23%, it's a asset heavy company, right? Obviously. And ROA is lower compared to Infosys and TCS. Their ROA is 6.03%. Now, would it be a fair comparison to compare a Maruti Suzuki to Infosys and TCS? Obviously not, because they belong to different industries. Yes, so if you're going to compare, ideally compare companies within the same industry, because otherwise it's not the right comparison, right? You're comparing a high capital intensive company with a low capital intensive company, and you are saying, okay, based on this, I'm going to select. So that would not be the right way of looking at how to select a particular company's a particular company. So I hope that was clear in terms of the profitability ratios. We discussed ROE, ROA, we discussed the net profit margins, we discussed gross profit margins, and so on. Now we're going to discuss about the liquidity ratio. So what exactly are liquidity ratios? So like I said, it tells you the company's ability to pay its short-term debt obligations, right? So payment to vendors, the rentals, the maybe the salaries, the taxes that they have to pay, and compliance remittances and other services payouts. They have a lot of these short-term, payouts which go from a company's pockets. So how well a company is able to manage those short-term expenses or debt obligations is what your liquidity ratio tells us. So if we look at, say, liquidity ratio, it's about efficiency of the company to manage working capital. How well a company can manage its working capital is determined in the liquidity ratios. So if you look at companies which have, which expanded their business without financial plans, so there have been a lot of companies who have not had a proper financial plan. They've had really bad working capital management, and they eventually shut shop. Okay, a very classic example, a lot of you would remember, we had something called as Subiksha Retail, right? So they had almost 1,600 retail outlets all over India, and it was a very big retail chain, one of the largest in the early 2000s. Okay, and their business was expanding fast, but then their margins were obviously much thin, right? They're very thin in terms of margin, and there was a massive mismatch in terms of the cash inflow and the outflow. By May 2009, they had closed all their stores and businesses due to a severe cash crunch. So the cash crunch, right? You might have a great business model, but if you don't manage your working capital well or efficiently, you will not be able to sustain that business. So, which is why looking at liquidity ratio is very, very important, because imagine you've invested in a particular company for the long term, but it's possible that the company is not even able to manage its short term obligations. Then what's the point of looking at all the long term ratios? Yes. So the two ratios that you should look at, of course, first is the current ratio, and then you have the quick ratio. Okay. So what is the current ratio? Current ratio is how many times the current assets cover the current liability. Okay, so you have the current assets of the company, which also includes cash. How many times that covers the current liability of the company? So higher the ratio, the better it is, right? Obviously, current ratio, if it is higher, it's a good thing, which means the assets is much more than the liabilities, and it's a good thing for the financial health of the company. The general understanding is that a current ratio of say 1.5 to 2 is supposed to be good. So if a company has a current ratio of say 1.5 to 2, it's considered to be a good thing. However, every industry would have different scenarios. I'm sure you agree with me on that. Now, what is quick ratio? Quick ratio basically does not consider the inventory while calculating the total current assets. Okay, because what happens is if you consider the inventory, it's you will have to first sell it off, right? And to meet those short-term obligations, if you're not able to sell off the inventory, then obviously there's a problem. So in the quick ratio, the inventory aspect is removed from the current assets, and then the ratio is calculated. So quick ratio is where the inventory is not included. So if we just look at the liquidity ratio examples again for Infosys and TCS, and guys, I'm saying this again, please don't take this as a recommendation for Infosys and TCS. I'm just taking this as an example to show you how these ratios work. Okay. So if you look at these two companies' ratios, both of them are placed quite well in terms of their quick ratio and in terms of their current ratio, right? Like I said, 1.5 to 2 is a good number, and both of them have their current ratios and quick ratios more than 2. But then again, every industry has their own challenges, right? So if you look at the liquidity ratio in terms of the automobile industry, so if you look at Maruti Suzuki, Tata Motors, and Bajaj Auto, as you can see, with this industry they face challenge, right? Manufacturing, automobile, because they are capital intensive companies. Even in terms of working capital is a challenge for them, and that is why you will see their current ratios on the lower side. I think Bajaj Auto is probably the only company, if you see in this example, which is placed quite well in terms of their current ratio and their quick ratio. Okay, so, like I said, it definitely impacts the cost of borrowing. So, if the current ratio is on the lower side, it will impact the cost of borrowing as well. So, like I said, Bajaj Auto seems to be like the only company which is placed quite well amongst the three that we are talking about here: Maruti Suzuki, Tata Motors, and Bajaj Auto. So this was about liquidity ratios. So like I said, it is important to look at liquidity ratios because they do help us understand the current scenario or the current situation of a company to handle its working capital. Now, the next ratio that we look at is the leverage ratio. Now, leverage ratio is again interesting because it tells us in terms of the debt which a company has. So every company wants to expand and grow. I'm sure that's a company's purpose, right? And obviously, these expansion plans need money. So, for any company, if they want to expand their business, they need money for it. Yes, which is nothing but the long-term capital requirement. Now, how can they get this money? So, they can get this money from two sources. They can get it from equity or they can get it from debt. Yeah. So, debt is they're taking loans. Equity is from the from equity pool or from shareholders. Now, imagine a scenario if a company were to raise capital from equity alone. So, if you're raising capital from equity, which means your investor base is going up, which means your equity shareholders are going up, correct? And then eventually you'll also have to share the profits with the shareholders, correct? So, if you're taking money from the shareholders, you also have to share the profits with the shareholders. So then what a lot of companies do and what a lot of existing shareholders, they say that why not borrow money from the market as a loan and pay it off along with whatever interest that we have to pay. Yeah. So which is why a lot of companies also look at taking debt or taking loans to fulfill their long-term capital requirements that they have. So Which is why in such cases, when when they are borrowing and they are able to manage their expansion plan, so it's a good scenario. Of course, it's not bad at all if you want to borrow money, considering the economy continues to do well. Yeah, I mean, imagine you've taken a loan and you're not able to service it, then that's a bigger problem. Yeah. So then how do you manage the situation? The question is, what if the economy starts slowing down, or what if the business starts underperforming? Then repaying that debt is not going to be easy, or servicing the debt could be a challenge, right? You have to pay the interest and the principal on time, which is a challenge. So delaying payment of debt would obviously affect the credit rating of a company, which might eventually lead to the downfall of the company itself, right? Credit rating is an important aspect in itself. So it is important to watch out for those companies which have high debt in their balance sheet. So if a company has very high debt in the balance sheet, that is what you should be a little cautious about. So what are the two most important leverage ratios that we're going to talk about? One is the debt to equity ratio, and then is the interest coverage ratio. So what is the debt to equity ratio? So total debt of the company, which is nothing but your short term and your long term liabilities, divided by your shareholders' equity. So basically, share capital plus the reserves and surplus and so on. Now, this ratio gives us a picture of the weight of debt of the company over its shareholders' equity. So, obviously, lower the ratio, better it is. The debt to equity ratio, the lower it is, the better it is going to be for any company. High debt companies get into trouble and even might close down. So I remember during pandemic, you had a lot of companies which could not sustain because they had so much debt, right? So which is why, so Vodafone Idea is, by the way, a classic example, right, of a high debt company which got into long term trouble. So what are which are some of the other high debt companies? So we have Adani Power, whose debt to equity ratio is 131 times. Mahindra Holidays and Resorts, debt to equity ratio of 11 times. Then you have MRPL, debt to equity ratio of 5.6 times, and then there's TVS Motors, whose debt to equity ratio is about 3.1 times. So we have all these companies which have high debt to equity ratios, and that is why they're in trouble. So when you're looking at the debt of a company, look at the debt to equity ratio, and this will tell you how much debt a company has, and should you really invest in that company if it has a lot of debt. If it's very high debt, is what you should be avoiding. Next, going by the earlier example, by the way, Infosys and TCS, they're zero debt companies. So this ratio is going to be zero for them. The debt to equity ratio is going to be zero because they are zero debt companies. Okay. The next interesting ratio is the interest coverage ratio. Okay. Now sounds heavy, but it's a very interesting ratio to be looked at. The interest coverage ratio basically talks about how many times the earnings of a company cover the interest expenses. Okay, so just listen to me carefully. How many times the earnings of a company, so whatever earnings the company has, how many times that covers the interest expense? So let me explain this in very simple terms. Suppose you and me, we are running our household, and say we have a home loan. Okay, now let's assume that my income is, say, about 90,000 rupees. I get monthly 90,000, and say my EMI is about 30,000. So in that case, my interest coverage ratio is 3 times, which means my income is 3 times of what I have to pay as my EMI, my loan. Now, suppose pandemic time, you've got a salary cut and your salary has gone down to 60,000 from 90,000. Now, your loan amount is not going to, I mean, your EMI is not going to change. You still have to continue to service your EMIs. So now your interest coverage ratio is 2 times, which means now from 3 times it has come down to 2 times. So ideally, the higher the interest coverage ratio, the better it is. Oh, and by the way, in this example, let me give you a simple caveat. When this calculation is done for companies, only the interest component is taken into account. For individuals, when we're looking at EMIs, the EMIs consist of principal and interest component. Okay, but here only the interest component is ideally considered when you're looking at the interest coverage ratio for companies. I just use this example to explain this concept in a very simple way. Okay, so when we're looking at the interest coverage ratio, like I said, it talks about the company's ability to repay the interest to the people who've given them the loans. Higher the ratio indicates the company is capable of serving the interest. Even if the earnings were to go down during, say, bad business cycles, the company will still be in a comfortable position to pay up the interest if they have a high interest coverage ratio. Lower ratios could be very worrying in bad times. So in this particular case, if the interest coverage ratio is on the lower side, that could be slightly worrying for a lot of people. So so when we are looking at examples, so let me just see if, okay. So at the same time, so when we are looking at examples, Bajaj Auto and Maruti Suzuki, they are also zero debt companies. So, like I said, Infi and TCS are zero debt, Bajaj Auto, Maruti Suzuki also zero debt, and Tata Motors has a debt to equity ratio of 1, which is well within the comfortable range. Okay. Now, what we're going to discuss. So, these are your profitability ratios, liquidity ratios, and your leverage ratios. Yeah. So, I hope these three important ratios are well understood. Now, what we're going to be talking about are the valuation ratios. Now, one thing that you have to understand is that we look at valuation ratios only when we have looked at all these other ratios. You don't first jump to valuation ratios, because what is a valuation ratio going to tell us? Valuation ratios help us in understanding if the company is priced well, right? So if it's overvalued, undervalued, fairly valued. And when do you look at if you want to, if the company is fairly valued? Only when you're convinced about a particular company. So if you're convinced that the company is fundamentally strong, their profitability ratios, liquidity ratios, leverage ratios, everything looks good, then you come to the valuation ratios only. And remember one thing, guys, valuation ratios, or for that matter, any ratio, as a standalone does not tell you anything. You have to compare the valuation ratios or any other ratios with its peers, or you look at the historical trend. Okay. Valuation ratio specifically, you compare it with the competition. Otherwise, a standalone number of a particular ratio is not going to give you any picture. Okay. So it's very important that when you are looking at valuation ratios, you don't just look at one company's valuation ratio and you say, yeah, okay, it's good or bad. You compare it with other companies and then you decide if it is fair or not. Okay. So now, what are some of the valuation ratios that we are going to look at, right? Which is okay. So before I actually talk about PE ratio and all the other valuation ratios, one more thing that let me give you a very interesting thing about what is value and what is price. They are two completely different things. Okay. So for example, if say you want to watch a movie, yeah, and normally say the movie ticket price is 200 rupees. Now that's the price of the movie ticket. Now, say it's the Diwali weekend, and now the movie ticket price has gone up to 600. Now, you agree that it is overpriced. It's not worth the value, but your family says that no, we want to watch the movie in the Diwali weekend, irrespective of what the price is. So you will still pay that 600 rupees, and you will buy the movie ticket. So, is the price and value are same? Not really, right? Is the movie ticket worth 600? Maybe not, but then you're still willing to pay for it. So what I'm trying to say is, when you're looking at valuation ratios, there could be companies which are highly priced, or which are overpriced, or which you might just think they are overvalued. Does it mean you should not be investing in those companies? Maybe not. It's possible that even those overvalued companies have the potential to give you good returns, and it's possible that companies with lower or which are undervalued may actually not do well at all. So it's not necessary that a overvalued company is not going to do well, or an undervalued company will definitely do well. There's no such this thing. So that's why I said that you have to first see if the companies are fundamentally strong or not. If you're convinced about those aspects, that is when you look at these valuation ratios. Okay. And so now, when we're looking at valuation ratios, we have, I'm going to talk about, say, 4 or 5 of them. So first is the PE ratio, which is the most common, most famous. All of us know about it. All of us look at the PE ratio, which is nothing but the price to earning ratio. And all of us look at the PE ratio when we want to invest in a particular company. So when we are looking at the PE ratio of a company, it is obviously the most followed, and it is nothing but the share price of the particular company divided by the earnings per share. So what is the share price divided by the earnings per share of the company? Now, whenever you are looking at the PE ratio, if say, let's assume that the market share, the market price of a particular share is 100 rupees, and let's say the earnings per share is 10 rupees, so your PE is 10. Okay. So what that means is that for every 1 rupee of earning, an investor is spend or investing 10 rupees. So for every 1 rupee of earning that the investor is going to make, he's investing 10 rupees. So obviously, when you are looking at the PE ratios within the same industry, the lower the PE, the better it is. So you look at companies with lower PE when you are looking at investing in companies, but within the same industry, which is very important. Okay. So then obviously you compare it with the market PE as well. So there's a general saying that the market PE ratio of say less than 18 or 15 is considered to be good. Okay. And in the last 2 decades, we have seen the market PE of 15, below 15, about say 3 times only in the last 20 years. Okay. Next ratio that we look at is your price to book ratio. Now, what exactly is a price to book ratio? So, price to book ratio is basically, so what is a book price? So, book price per share is the overall net worth of the company divided by the number of shares. So, you don't have to worry about the formula, like I said again, but it just simply means that when it comes to, say, if the market price is, say, 100 rupees and the book price per share is 50, it means that for every 1 rupee of book price, an investor is paying 2 rupees. Here also, the lower the ratio, the better it is. As low as the book price can get, that's good. And ideally, if if PB ratio is say 1 or less than 1 for a particular company, you can confidently invest in that stock. Okay, you can confidently invest in a stock with a PB ratio of 1 or less than 1. So if we are just looking at again Infosys and TCS example that you can see on the screen, so the PB ratio for TCS is 10.7 and PE is 37.6, and it's slightly lower for Infosys. So of course we looked at for Infi and TCS, we looked at a lot of their other ratios. We looked at their profitability ratios, we looked at their liquidity ratios. So when we're looking at valuation ratios, Infosys is slightly it looks better compared to TCS. But what you have to understand is that because TCS had other ratios which were stronger, the market is going to take that into account, and the share price is obviously going to be higher, right? For a company which is doing fundamentally strong and the ratios are, they have healthy ratios, the market is going to take that into account, and which is what is going to be reflected in the share price of that particular company. So does it mean Infosys stock is cheap? Not really. From a relative valuation point of view, if you see a PE ratio of 35, PB of 5.6, it does not. It does indicate that the share price had a good run up and may be expensive considering the current market conditions. So you can consider, in IT industries, P and PB ratios to understand the relative valuation. So if you look at, say, Nifty IT PE ratio is about 35.7 and the PB of Nifty is about 11.11. So which is why when we are looking at PB ratios, PE ratios, again, you also compare them with the market to see, or with the industry average to see if, they're fairly valued or not. So again, like I said, guys, these are only for the purpose of, only academic purpose. Please don't take these as recommendations in Infosys, TCS, or any other examples that I'm taking. Next, what we have is price to sales ratio. Okay, so sales per share is, sales per share is total sales by the number of shares. Yeah, which is a very simple, understandable formula. So in this particular cases, where lower the ratio, better it is. Price to sales ratio also, if it is on the lower side, it is considered to be a good thing, or it's said that it's fairly valued or undervalued if it is on the lower side. So if you just look at this example again, I'm going to again expand the screen for all of you. If you just look at this example again, you can look that price to sales ratio varies in industries, and you're comparing it with the overall market. If you look at, say, computer services, right, where TCS and Infosys are generally, they fall in that particular segment, the price to sales ratio is 5.65. Okay, so let me just highlight that for you. So if you can see here, it is 5.65. Whereas if you look at, say, industries like apparel, if you look at industries like auto, yeah, so there, the price to sales ratio is much lower. So, these definitely look undervalued, these in the particular segments. If you look at banks, for example, yeah, banks look slightly overvalued in terms of price to sales ratio compared to other industries. So please do look at these ratios like profitability and liquidity ratios before you come to any conclusion. So you compare it with the industry average, you compare it with compare it with the competition, and then you eventually decide if the company works for you or not. Next is price earnings to growth ratio. So let me just quickly get to that slide. So that's, we call it the PEG ratio. Now, generally, when investors are looking at PE ratio, PB ratio, they're saying that, this is all historical, right? What I want to look at the future growth of the company, because you are investing in the future of the company and not really, the past. So if you're looking at the future potential of a company, that is determined by the price earnings to growth ratio. So what does the PEG tell you? So it doesn't take past into account, it takes the future into account. So in this case, if you're looking at the PEG ratios, expected growth potential of the company is taken. So how do you calculate PEG? It's nothing but the PE ratio divided by the expected annual earnings per share growth. So what is the expected EPS growth? So first you take the PE, you divide the PE with the expected EPS to come to the PEG ratio. And the general thumb rule for PEG is that the ratio less than 1, the company is supposed to be fairly valued or undervalued. So again, PEG should be on the lower side, ideally less than 1. Okay, next is the dividend yield, which is the last valuation ratio that we're going to discuss. Now, dividend yield, see, whenever you are looking at, when you look at a particular company and you look at the net profits of that which are earned by that company, it is understood that not all the profits are going to go to the shareholders. There's only a part of it which is going to go to the shareholders, because some of the profit is going to be retained back by the business to run its day-to-day operations, right? So only a part of it is given to the shareholders, and we call that as dividend. I'm sure all of you understand the concept of dividend, and they are declared as a percentage of earnings per share. So dividend is always declared as a percentage of earnings per share. So dividend declared by the company divided by the market price per share gives us the dividend yield. So what is dividend yield? The dividend declared divided by the price per share. So if we look at the market, say if the market price of a share is say 100 and the dividend declared is 5, then the dividend yield is 5%. So returns generated, like I said, so you have to look at the dividends as well, and dividend yield generally higher is considered to be better. Now, in all the other valuation ratios, the market price or the share price was a numerator. In dividend yield, it is the denominator, which means dividend yield and all the other valuation ratios, they move inversely to each other. Okay. And which means the dividend yield as a ratio should always be higher when you're looking at valuation ratios. All the other ratios should be lower. So your PE, PB, PEG, your price to sales, all of them should be on the lower side, whereas dividend yield should be on the higher side. Okay, they are negatively correlated. So if we just look at Infosys and TCS example again, right? So if you look at the dividend yield for Infosys and TCS, so for example, for Infosys, the dividend yield is about 1.5, and for TCS, it's about 1. So which means in terms of dividend yield, Infosys is better than TCS. So similar results in terms of two valuation ratios. Now TCS is priced higher compared to Infosys. So, which is why it is important that we look at valuation ratios along with the other ratios and then understand how it works. The one thing that you have to understand is that for all these well-established companies, you will still be able to, get these ratios. You can look at all the information and decide by looking at all these ratios. But when you look at young startups, right now, for a lot of these young startups, it may not work, as they will be showing negative cash flows and they will not be showing any profitability. The young startups are not going to show profitability, they're not going to show any positive cash flows. So then you might just say that, okay, then I don't want to invest in those companies, which is not right. So whenever you are looking at these younger, new age startups, then these ratios may not make a lot of sense, because then you're really investing in just the future potential of that particular business. Okay. So just to conclude, I would like to say that, of course, quantitative analysis is important. Ratios are important. Numbers are important, because they are going to teach us. They are going to help us understand the company's performance. They're going to help us the past. They're going to help us understand future to some extent. But what is very important is for you to understand is that the qualitative aspects are equally important. So when you're doing the fundamental analysis of a particular company, You look at the numbers and you look at the qualitative aspects like the management of the company, the future growth, what are the growth plans they have, what is the business model. You look at all these qualitative aspects as well, and then you eventually take your call in terms of which company you want to invest in. Okay. So great. So with that, I think I would like to conclude my session and open to questions now. So I'm sure you guys have a lot of questions, and I would be more than happy to take some of those questions for you. Okay, 2 or 3. So Mr. Srinivas asking 2 or 3 important ratios for quick decisions. Mr. Srinivas, I would strongly say that you should look at, I have only picked out those few important ratios that you should look at. If you leave aside the valuation ratios to start with, if you're just starting the analysis of a particular company, then you have to look at those few profitability ratios, leverage ratios, and liquidity ratios. And they're literally just 5, 6 of them. You look at all these ratios and then you decide, because all these ratios have their role to play, right? They're all equally important. If you look at, I've not explained all the ratios which are available because all the ratios may not be important for you, but those 6, 7 important ones I have explained. So I would recommend that you at least look at those 6 or 7 ratios before you decide which company stocks you want to buy. Okay. So now again, no recommendations. I cannot tell you which company stocks are better, but I would just say that all the examples that I've used were only for academic purpose. Please do not take them as any recommendation. Thank you so much for all the wonderful feedback that I'm seeing on the chat. Thank you so much for that. Okay. So what are some of the questions that you guys have apart from the recommendations, please? Uh, okay, so I would say if you want to look at all these ratios, someone's asking from where can you see those ratios? You can go to the Groww website and or the Groww app, and you'll be able to see all the ratios for all the companies. So yeah, so you should definitely be able to do that. Okay. So great. Okay, so I think we can end the session with that since we don't have too many questions. Thank you so much, all of you, for joining in today, and I hope the session was useful. So thank you so much, and I wish you all the best with your investment journey. So take care and bye bye.